And let me just go here. So good afternoon, and sorry for being late. As I said, I had a problem with my connection at home. Okay, so we are now going to deal with the last chapter before we move to a kind of general conclusion, where I will discuss a few important issues for the years to come. Well, now we reach the last point, which is financial policy. In other words, what we have done so far, if you remember the structure of the balance sheet of an insurer, on one side, the right side, on the liability side, you have a large amount of liabilities, which corresponds to the insurance funds collected by the insurers when they sell their insurance policy, in non-life as well as in life insurance. Okay, so each time the insurer is selling a policy, it means that the insurer is buying a risk to a certain extent. So this is a liability, because the consequence of that is that the insurer will have to pay for the claims to compensate the victims, to compensate the policyholders for whom the event or the accident which was covered has occurred. But indeed, to do so, the insurer is collecting premium, okay? And these premiums are kept for a period of time, because there is a delay between the moment when the insurer is receiving the premium and the moment when the money collected is used to pay claims. Okay, and because of that, as we have seen in the first section of this course, there is a certain amount of fund available for the insurer, and these funds are indeed invested. So now this is what we are going to talk about. We're going to move from one side of the balance sheet, the liability side, which has to do with the type of policies sold, the pricing issues, and so on. Now we move to the other side of the balance sheet, where the assets are indicated, to just look at how these assets are invested. So insurance financial policy, this is what we're going to talk about this last session. Well, indeed, for each portfolio manager, the trade-off to be considered is a trade-off between risk and return. Okay, so the question here, the very first question we need to raise is, what are the drivers of the risk-return position of the insurer? And in particular, what are the main determinants of the insurer's global risk exposure? Okay, which is the very first point we are going to address. Then we are going to question the portfolio structure and risk control. In other words, what I'm saying here, what I mean is that indeed the structure of the portfolio, which will be built by the insurer, okay, depends on the risk appetite, as we call it usually, of the insurance company. To which extent, how much risk globally is the insurer ready to accept? Okay, on one side, the risk is an underwriting risk, which sometimes we say technical risk. So on the other side, you understand that portfolio managers have to be, to a certain extent, prudent. Why? Because you cannot accumulate risk on both sides of the balance sheet. So the idea is that since the liability side of the balance sheet is risky because I remind you that insurers are taking risk when they sell policies, and they don't really know exactly how much they will have to pay later on. Okay, so they have a risky liability. Okay, you cannot add too much risk on the asset side because you already have risk on the liability side. Okay, that's why we'll see that the portfolio structure is usually made of a lot of assets which are rather safe. And the reason for that, is that you cannot, as I said, you cannot add too much risk on the asset side since you already have a certain level of risk on the liability side. Okay, so this is the point we are going to look at. How is the portfolio structured, taking into consideration this risk position, which affects both liabilities and assets? Well, there is one particular item as far as risk management is concerned, which is worth looking at because it's a real issue for insurers. Okay, this is the interest rate risk. You know what it is. You have heard of that in other courses with my colleagues. You know that when interest rates are moving up and down, well, it has an impact on the value of assets. Okay, and therefore it generates a kind of volatility in the value of the assets and therefore a risk. Okay, so that is there is a specificity of insurance companies as far as the interest rate risk is concerned, and therefore it was necessary to have a close look at it here. Okay, and then we will conclude by, let's say, some elements of regulation. Insurance companies are usually highly regulated in most countries. The reason for that is that regulators want to make sure that insurers will be able to pay claims. Okay, so the idea is to create a level of safety for the insurers that would reassure the policyholders so that they can be confident in buying insurance because they can be certain that they're going to be compensated if the event insured occurs. Okay, so one main aspect of this regulation is to oblige companies to have a certain amount of equity, of capital in their balance sheet. Okay, and as I told you already in the introduction, the rules which are in place for the insurance companies as part of a regulation which we call solvency. Okay, well, these rules are very, very similar to the rules which apply to the banking sector. Okay, so again, you should be familiar with the presentation which I will make. Excuse me, I just forgot to. Okay, sorry for that. Well, so let's start. So we are going to adopt a portfolio approach to insurance. This concept of portfolio approach, I have already mentioned that in the introduction, because here it really makes sense. I remind you that if you look at the liability side, you can see this block as a kind of portfolio, an underwriting portfolio, as I write here, because what you have on the liability side is mostly all the liabilities resulting from the sale of policies. Okay, so you have an underwriting portfolio because you have different blocks. Each block which I have represented here, okay, would correspond to an insurance business line. Okay, for instance, the first block could be motor insurance. The second block could be property insurance for household. The third block could be industrial coverage. Another block could be liability risk. Another block could be, well, you also have life insurance there and so on. Okay, so each block would correspond to a line of business in insurance. And else, you see, the idea, we've seen that already when we discussed the role of reinsurers. The insurer will make sure that this portfolio is well diversified. Why? Because that diversification contributes to reduce the risk. So diversification is a key element on the liability side as well as indeed on the asset side, as we'll see. There are some other elements in the balance sheet on the liability and equity side, what I call the operating debt and others. It might be some current operating elements which are not so important for our analysis. For instance, the fact that if you have there are tax elements there are some elements of payment which have to be made soon but which have not been made yet. For instance, when you sell insurance, you have an agent and the agent receives commissions. So the commission, it may take 1 month or 2 months before they are paid. So that would be part of the operating debt, for instance. Okay, so all type of element of cost, of operating cost, which have to be paid yet. Okay, but this block is indeed, for our analysis, not that important. Okay, what do you have on the asset side? Well, you have an investment portfolio now, an investment portfolio which is also made of different blocks. Okay, because the money held by the insurers are not invested in a single type of asset. Indeed, okay, you have different types of assets such as shares, bonds, real estate, and you could complete the list with all type of instruments which exist on the market. Okay, remember what we said about reinsurance. even if the insurer decides to transfer part of the risk to the reinsurers, okay, well, the insurer, the direct insurer, remains fully liable towards its clients, okay, towards the policyholders. In other words, it means that on the underwriting side, okay, on the liability side, you have the full underwriting liabilities, which corresponds to the estimate of what will be paid, what will probably be paid in the future to the policyholders, without considering the fact that part of it will be paid by reinsurers. So how do we account for reinsurance? You remember, rather than having a minus on the liability side, we have an asset on the asset side, which corresponds to an estimate of what you should receive from the reinsurers, okay? In other words, reinsurance receivables, okay? Well, and the higher the proportion reinsured, the higher this block in the asset side. And you also have operating asset and others, okay? Some premiums which have been received by the agent, but which have not yet been transferred to the insurer, for instance, all type of element of revenue, which are minor elements in this analysis, which has not much of impact on the risk exposure, and therefore we are not going to consider that too much in our analysis. Okay, these are minor elements at the bottom on both sides, the operating current elements. Okay, well, so now this is a kind of exercise which I usually ask the students to do in class, but indeed it is kind of difficult here. So I just left it on the slides, but I don't have the intention really to do it because it's very tricky to do that online. Okay, but you can look at it briefly, and I really recommend that you try to do it so that to make sure that you have a clear understanding of the structure of the balance sheet and the income statement of an insurer. Okay, so let's have a quick reading if you like. The first line, for instance, premium income for the year 1,000. That indeed would come on this side in the income statement, premium. Operating and distribution costs 240. This would be in the income statement on the line operating cost. Insurance provisions end of year. So insurance provision 1,400. So you have this in the balance sheet. Okay. Invested asset 1,650. This would be indeed on the asset side in the balance sheet. Miscellaneous operating assets amount to 50 and operating liabilities to 30. You have it on both sides of the balance sheet also. Reinsurance, that's where it is a bit more complex. The company has signed proportional reinsurance treaties, transferring 20% of its risk exposure to reinsurers. So this should be in the balance sheet, okay, under the item reinsurance receivables. Okay, reinsurance receivables will represent 20% of the estimate of the claims to be paid. In other words, since the insurance provision represent 1,400, okay, which is what remains to be paid to the policyholders, we can estimate that 20% of that will be paid by reinsurers and should appear as reinsurance receivables. Okay. It is agreed that the corresponding insurance resources remain with the company, paying 3.5% interest to reinsurers. Okay, so it is agreed that corresponding insurance resources remain. It means that part of the asset held by the company corresponds to this amount of provisions which have been transferred, and an interest will be paid 3.5%. Okay, for the year, reinsurers have received 200 of premiums ceded and have contributed for 180 only to the cost of claims. So if you look at the income statement, you have the level of, if you look at the underwriting activity, you have the premium ceded, so you have 200, and contribution of reinsurers to claims, which is 180. Okay, the average return on invested assets for the year is 5%. Okay, so that will give you an idea about the net financial income. Okay, and the average and the income tax is 30%, so that you can calculate the tax. So based on all this, and you can verify this is what you would have. Okay, so this was a quick correction of this exercise, but I really recommend that you look at it, you try to do it yourself, and you check whether you found the right result. Well, I just remind you there also some ratios which are useful. The combined ratio, you remember what the combined ratio is? The combined ratio is a comparison between the premium you have received and the total cost incurred by the insurer. In other words, you look at the cost of claims plus the admin and operating cost, which you compare to the premium. Here you have a combined ratio of 1.02. Okay, it is above 100%. In other words, it means that there is an underwriting loss, because if this ratio is above 1, if you remember, it means that the total cost exceed the premium received. Okay, which is in line with what you find here in the income statement, with an underwriting income which is negative with -40. Okay, after reinsurance, and -20 before reinsurance. The return on equity is just the net income over the equity held. Okay, and the implicit cost of insurance resources before reinsurance is 143. In other words, you look at -20, which you compare to the amount of funds, the insurance funds in the balance sheet, the insurance provisions, which corresponds to 1,400. Okay. Well, so this is just because we started with a representation of the balance sheet. So I wanted to make sure that you have a clear understanding of how these balance sheet and income statements are really built and structured. Okay, so it was a quick correction. Probably most of you have not understood much, but I really recommend that you take a bit of time to look at this. Well, so let's come back to this balance sheet as we have reprinted it to start with. Okay, so it's really a twin portfolio, with a portfolio on the right side made of policies and another portfolio on the left side, on the asset side, an investment portfolio, to which we should add reinsurance receivables. We can be treated as a particular block of assets. Okay, well, so what I want to look at, to focus on, is the equity. Okay? In other words, here I'm isolating the equity. Okay, why? Because, you know, particularly when we're going to talk of a solvency, the idea is to what is solvency all about? It means that if you want to have rules to maintain a level of solvency so that the risk of a negative equity, which would correspond to the failure of the insurance company or the fact that they wouldn't have enough money to pay claims. Okay, so the negative equity should be very unlikely. You know, solvency has to do with the probability of an equity that would fall down to a level that would create a difficulty for the insurer to pay claims. Okay, so that's why I'm focusing on the equity, and we are going to look at the return on equity. Okay, so the equity, based on the balance sheet we have, is made of what? Indeed, the equity is the value of assets minus the value of liabilities. So value of assets, you first of all have the investment portfolio, to which you add the reinsurance receivables. These are the two asset blocks. Okay, minus the debt made of underwriting portfolio, and I have added at the end, you know, just because I told you that these operating elements are not too important in the analysis, as a final block, which is the net operating assets, which would be operating assets and others minus operating debt. Okay, well, for the sake of simplification, you know, from that, I will simplify a bit further for the sake of simplicity again, by telling you that there is a kind of compensation between operating assets and debt. Okay, for the sake of simplicity. Okay, so it will disappear. And then if I just cancel out the net operating asset because they cancel out, if we assume that, well, then we have two blocks basically. One which has to do with the financial policy, which is the blue block here. You can see that the equity is an investment portfolio, okay, plus another block which is made of reinsurance minus the underwriting portfolio, okay. In other words, you have two blocks, one which really corresponds to the financial management, the investment activity, and the other block which integrates reinsurance together with the underwriting activity. These two activities are interrelated indeed, because the reinsurance is there to kind of structure properly the underwriting portfolio. So you have to put these two things together. In other words, we have two blocks here, which we are going to consider for the developments of our analysis. Okay? So it's a simplified version, as you can see, of the balance sheet of an insurance firm to isolate equity, and this is what we are going to focus on now. Well, so here we are. I write it a bit differently here. It's the same, you find the same elements. Well, the equity is seen as asset minus liabilities. A for assets and L for liabilities. The assets are made of invested assets, investment, okay? And you have as the liabilities, you have the provisions, insurance provisions, okay, minus reinsurance receivables, okay? In other words, here in my analysis, even though legally only the provisions counts toward the policyholders, but financially, here you can integrate these two elements, saying that the reinsurance receivables comes as a kind of minus in the total liabilities of the insurer, okay? So we call it the net underwriting portfolio. We could also say the underwriting portfolio after reinsurance, okay? So the invested assets, they have a certain risk and return. It depends on how the portfolio is structured, but you have a risk return of the investment portfolio. You also have a level of risk of the liability portfolio, of the underwriting, net underwriting portfolio, because as I repeat, again, you never know how much claims you will have to pay, so the liabilities are at risk, okay? You don't know exactly what you are going to pay. And rather than a return here, there is a cost of funds, so the return would be negative. It would be more a cost than a return, okay? But a negative return because, as we have seen, most of the time you have an underwriting return which is negative, which is because, as I have explained, when we were considering the pricing techniques, well, it is normal to have a loss on the underwriting side because it is a way for reinsurers to provide a remuneration for the saving, for the precautionary saving they have received from policyholders. Remember, this is a point which we have discussed in the pricing section, okay? And I've added the fact that you cannot ignore, even though this correlation is rather low, but you cannot ignore the fact that there is or may have a kind of correlation between these two random elements, okay? So you have here a global portfolio made of assets and liabilities, and I repeat, the relevancy of an asset liability management approach, okay? Where you have risk and return on the asset side, a risk and, let's say, return or negative return, a cost on the liability side, and a correlation between the two here. So, and this will generate the risk-return ratio for the equity holders, okay? It's a combination of these two portfolios, okay, considering all the correlations, which will determine the equity risk-return ratio, okay? So here we are. Now, we are going to modelize this, to use our knowledge in statistics to try to formulate this. So let's call the investment income RA, where R would be the return on invested assets in terms of percent, okay? So RA, If you have an amount of asset of 1,000, if R is 5%, then it means you earn 5% of 1,000, which is 50. Okay, no problem there. The underwriting balance, which I call the return there, I will introduce a cost of fund, UL. U is the cost of insurance funds after reinsurance. Okay, so this concept of cost of funds, we have seen it when, again, I refer to the pricing section of this course. Remember, U is a cost, or if you prefer, would be a negative return. Okay, so UL, U is a rate, L is the amount of liabilities, okay, the net liabilities, okay, in other words, the value of the net underwriting portfolio, integrating reinsurance, okay. And then the total income is what? The financial income minus the cost of funds. In other words, RA minus UL. Okay? Well, if you express the return on equity K in terms of percentages, you have K, which is equal to the total income over the amount of equity E. Okay? So this is the formula for the return on equity, where A represents the invested assets and L, the net underwriting portfolio. Since indeed we have necessarily A equal E plus L, okay, we can change a bit this formula, and you will understand later on that it is necessary to have an in-depth analysis of the risk exposure of the company. We can change this first expression of the return on equity in terms of this with two elements. A would be R times 1 plus L over E minus U times L over E. Here, the interesting thing is that you see what are the determinants of the risk-return ratio for the equity. First of all, you have the volatility of R, the return. R, the return on asset, you can define a standard deviation for it and an expected return. Okay, U is the same. U is the cost of funds, of insurance funds, okay, which will depend on the volatility of claims and so on. So U is also volatile. So you could measure and try to anticipate a standard deviation for U, as well as an expected cost of funds, okay? But there is another parameter which is also very important, which is L over E. And you should look at L over E as a leverage ratio. In other words, what you find here is that the cost of equity will depend on the return on equity, will depend on the return on asset, taking into consideration the leverage, you see, because R is multiplied by 1 plus the leverage, L over E, minus the cost of funds, also impacted by the leverage. Okay, so you see the leverage, L over E, which is, in corporate finance, you have studied the financial leverage, and you know that it has to do with the impact of the debt-equity ratio on the return on equity for shareholders. Here, we have exactly the same thing. Here, the debt is represented by the net underwriting portfolio, which is a debt for the reinsurers, okay, the net debt, okay, and E is the equity. So L over E should be seen exactly as the financial leverage, the debt-equity ratio, which you have studied and considered in your corporate finance course. Okay, so we are going to use this equation now to go a bit deeper in the analysis of the risk and return of the insurance. So now we are concerned with the equity risk. Why? Because in the end, what we want to discuss is the solvency issue, making sure that insurance will not fail. Insurance will not fail, or you can put it differently, make sure that the equity will not fall down in the negative domain, okay? So the variance of K, if you take this formula for K, you can obtain this. I'm not going to demonstrate that. I'm assuming that you are capable of calculating the variance of K, knowing the formula for K. Okay, you can just, if you take the first block for KR time 1 plus L over E, then you have the variance of R time the square of this factor, 1 plus L over E. You have the same for the second block. So the variance of U, which is which represents the volatility of the cost of funds, okay, time the leverage, again, square, and then to take into account the correlation that may exist between the return on invested asset and the cost of funds, we integrate the covariance between R and U, minus 2 covariance, you know the formula of the variance of a sum, time 1 plus LE time L over E. Okay, so here you have, and normally, considering what you have seen with my colleague already, you shouldn't be surprised or you shouldn't be unfamiliar with this type of formula. Okay, so now we are going to follow to go deeper in our analysis using this formula, because this formula provides us with the volatility of the return on equity, which is what we are interested in. And again, you see, you can see all the parameters that will have an impact. The volatility of the return on assets. So it depends on the financial policy, which is our topic in this section. The volatility of the cost of fund, sigma U, okay, which reflects the structure of the underwriting portfolio. That's where, you understand that having a diversified underwriting portfolio is a key element, because it will contribute to reduce the volatility of the cost of funds. You can understand also the role of reinsurance. More reinsurance will mean that the volatility of U will decrease also, okay? So both reinsurance and the diversification of the underwriting portfolio would contribute to reduce the standard deviation of U, okay? And then you have the covariance between the two elements, and I will give you some illustration later on for you to understand that this has a value, okay? We already have discussed this concept of covariance between R and U when I have introduced the concept of underwriting systematic risk, the beta U. And I told you that beta was kind of negative. And if it is negative, which is what is expected normally, you see that since sigma RU is negative, minus 2 sigma RU becomes positive. In other words, the correlation that may exist being negative between the two blocks of the balance sheet contribute to increase the risk. To put it more, let's say, clearly, it means that if the company is not doing well on the financial market, because, for instance, there is a bubble that burst or an economic crisis or whatever, usually it coincides with an increase in the cost of claims, which is not quite surprising. When you have an economic crisis, usually you have more accidents, okay? This is what is meant by this negative covariance, If the return on equity, if the return on assets, the return on investment is going down, usually we see the cost of claims going up, okay? Hence, you have a negative covariance between R and U. If it is negative, the final block of this equation becomes positive because you have minus 2. Okay, so, it kind of aggravates the risk exposure of the insurer. Well, so based on this, I just remind you that we could also have taken the CAPM, which is sometimes done in certain papers or theoretical papers. Then we will have something very similar. We would have the equity beta, which would be another measure of the risk. Okay, it would be a systematic risk of the equity, which would be the beta of the return on investment time 1 plus LE minus beta U, okay, time L over E, okay? Again, if you assume that beta u is negative, for the reason I have just mentioned, then this last element, this correlation which exists between R and U, would aggravate the risk by contributing to an increase in the equity beta. Okay, but for the following, I'm not going to use the CAPM. Why? Because it's theoretically quite attractive, but practically it's not quite easy in terms of measurements and so on. Why? Because, for instance, we look at the beta of the underwriting risk, but you have no insurance policies are not traded on the market, so you have no data for this. So the underwriting beta is more a concept than a parameter which you can really use for a decision-making process, because quantification is really tricky. You can get a quantification of beta u at the global level if you look at the global underwriting portfolio of insurance. But if you want to have a beta u that would make sense for each line of business, motor insurance, casualty insurance, property insurance, liability insurance, and so on, then it would be very difficult to have a specific beta for each line of business. So I just mentioned it because you may find it here or there, okay? But for the following, I'm going to use the traditional measure of the variance of the return on equity. Okay, so I just remind you this. What you have in this formula, it is typically what you find also in this document. I have already shown you this slide in the first discussion we have in the introduction, when I was describing the business model of insurers, where you have the underwriting result on one block, the investment result on the other block. What they call the solvency ratio is not exactly the debt equity ratio which we have considered in our formula, but it is strictly linked to the L and E. We could transform this ratio in terms of a L and E also, and you see that the return on equity would depend on these two blocks, their performance and their volatility also. Okay, so it was just to remind you this, and to show that, also to insist and show you that the development I have made with this statistic really corresponds to the business model which we have presented before. Okay, the ROE is really the final outcome, of the management of two blocks, which is the underwriting block and the investment block. Well, now just to show you the few data which exist concerning the correlations, you see, at least correlation between the different lines of business, just to show you that it's important to diversify the underwriting portfolio, and you would benefit. And you see that here you have some lines which are rather well correlated with ratios such as, if you look at commercial auto and personal auto, 0.63. So it means that this line of business are, when you look at the claims payment and so on, it's highly correlated, but you have some lines of business which are not correlated at all. If you look at medical malpractice, for instance, it is not much correlated with general liability, okay? Because you find a very small number and so on. You have sometimes you even have some negative correlation, minus 0.04 between fire risk and the medical malpractice. It's true that we don't see why we would have a correlation, but you see, insurers, they take this into account to structure their underwriting portfolio to diversify it. Okay, based on this type of matrix, you could try to look for the optimal diversification within your underwriting portfolio. Okay, now, these are numbers for major US lines of business. Both period, it has been calculated for a period of how many years? 76 to 2016. So you see about, if I'm right, 40 years. Okay. Well, so now, based on this, with the formula of which we have defined before, this formula, let's now look more precisely at the investment policy of insurance companies. The investment policy, what we need to repeat to start with, underwriting and financial decisions are interrelated. That's a point which you need to keep in mind. Why? Because there is a covariance between the two. Okay, so you cannot decide. Ideally, you cannot decide on your investment policy without considering your underwriting policy. The two things should be dealt with together. That is typically the meaning of the ALM approach, asset liability management. Both have to be managed together. Okay, and the financial decision will concern the investment portfolio R and sigma R. But what is the proper trade-off between R and sigma R? It's not only the structure of the portfolio which counts here, but also the trade-off between the return on this and the risk. And the other point will be also the amount of capital which is necessary to limit the risk exposure, because you see that the leverage L over E, has a strong influence in this formula. Okay. And the CAPM approach, as I mentioned before, would lead to this. So if we look at just to have a first look at the most likely investment portfolio structure, let's take for a minute, I told you that I'm not going to use it, but just exceptionally for this slide, because it is simple, to give you an idea about the typical structure of the investment portfolio of an insurer. So you understand this formula. From the formula of the return on equity, we can obtain the expression of the equity beta. Of course, I didn't mention that, but I'm assuming here that you are very familiar with the concept of systematic risk, I mean the beta, okay? And the CAPM, the capital asset pricing model, which you certainly have seen with my colleagues when talking about the portfolio management and the cost of funds and the like. Well, from this formula, we can derive beta R, okay? Beta R, which is the level of risk, systematic risk of the investment portfolio. It is equal to beta U times L over E plus beta equity over 1 plus L over E. This is directly derived from the formula above. So I guess you have no problem there. If I'm doing that, it's because there are some elements which we know, which we can observe. Okay? What kind of assumptions, reasonable assumptions we can make based on some data which are available? Let's say that insurers would say, I don't want, for the sake of safety, I don't want the equity beta to be above 1.5. And if you look at the equity beta of an insurance company, you have numbers of that type. So I write it as a risk limit because you understand that if you have a very high equity beta, it means that the volatility of the equity return might be high. Okay? It would mean, for instance, that would you have a bubble bursting on the financial market or a crisis on the financial market, it would mean that with an equity beta of 2, if the stock market drops by, let's say, 20%, then the value of the equity of the company would drop by 40%. You see? So there is, in terms of risk appetite, the word risk appetite is a wording used in risk management. It refers to the level of risk which seems acceptable, the maximum risk which is acceptable for a company. So the risk appetite could be here limited to an equity beta of 1.5. Let's assume that beta U is minus 0.1. There are some references, theoretical papers which have been developed. We have an estimate which is around this. Okay, it's rather low and it's negative, as I told you already. Okay, meaning that I remind you what it means. It means if this is negative, it means that if, for instance, the stock market, you have a crash, with the return on assets moving down dramatically, with the stock market index moving down, okay, then it means that the cost of funds, due to the increase of the cost of claims, would go up, okay? So the return on assets would go down, whereas the cost of funds would go up. That's what it means, a minus in this case. So it's an aggravating factor indeed. And let's take a ratio of L over E of 3. Okay, so it means, for instance, that 3 would mean that you have 25 of equity for 75 of insurance underwriting liabilities. Okay, so 3/4 of debt and 1/4 of equity in the balance sheet, which is also reasonable for our analysis. Okay, so if I take these numbers, what do I find? I find an investment, if you want, in other words, what I'm saying here, if you take as given the structure of your balance sheet with L over E of 3, if you assume that beta U is minus 0.1, and if you have a risk limit, if your objective is to have an equity beta which does not exceed 1.5, then your investment portfolio should have a systematic risk which does not exceed 0.3. Okay, so now the next question is, but what kind of portfolio does it represent? A beta R of 0.3. Well, assuming, for the sake of simplicity and to be short, that there are two possibilities for the insurer: to invest in the market index, for which the beta is 1, okay, or in risk-free bonds, for which the beta would be 0, okay, then it means that the portfolio structure that corresponds to a beta R of 0.3 would be made of 30% invested in the market portfolio and 70% in risk-free bonds. In other words, based on this, and these are realistic numbers, it shows that usually, it explains why, when you look at the data, usually insurers invest in very safe portfolios. They are very prudent. Sometimes they are criticized by bankers, saying, well, look at these guys. They really are not good because their performance on the asset side is not that good. They could match much better, but they don't want to take risk and so on. Why is it so? Just because I remind you that you cannot take risk on both sides of your balance sheet. If you have a risky liability side, you have to be careful on the asset side and take a bit of risk, but not too much of it. This is exactly what you observed here. So what we're going to do now is to have a more precise analysis, okay, and a simulation, okay, but you'll see that we will come back with realistic assumptions to this type of portfolio structure. So now, rather than looking at the beta, we are going to come back to a more realistic approach, because the beta approach, I would say, is very theoretical, okay? Very difficult to quantify if you want to get into the details of the insurance business. If you want to detail, taking line by line, the insurance business and the different lines of assets, then using the CAPM is not practicable, I would say. So now let's first of all reflect on the objective of the insurance company. Let's say that solvency has to do with the protection of policyholders, making sure that the company will be able to pay claims. Or in other words, you can put it this way, making sure that the equity of the company will remain positive. Okay? And therefore, you could express the risk appetite in this way. Okay? The probability of a loss above 50% of the equity should not exceed 1%. Okay? This is a typical approach to risk management, the type of objective which you see in the definition of risk appetite. Okay? So let's have this approach. It is an example, an illustration indeed, but it is something realistic. Okay? So if we want to write it more precisely, it is equivalent to the probability of return on equity that would be minus 50% should not exceed 1%. Okay, if your return on equity is minus 50%, it means that you have lost half of your equity. Okay, that's similar to the expression above. So our objective would be to have a probability of K lower than minus 50% to be lower than 1%. Okay, this is our objective in terms of risk exposure. So now, how are we going to look at this? To make a simulation later on, to find out what should be the investment portfolio. Let's assume that you have a return on equity with a mean mu k and a standard deviation sigma k. And for the sake of simplicity, again, I'm assuming a normal distribution. No, a bell curve. Normal distribution, because there are some properties which simplified the analysis. Okay? And the lower 1% limit. Okay? If you take 1%, which is the probability which we consider, and if we look at the limit that corresponds to 1%, we can obtain it by taking a distance which is 2.33 times the standard deviation of K. This is a property which we already have used in the pricing analysis and with which you should be familiar again, okay? So if I look at 1% probability, it corresponds to a limit here, which is on the left side of mu K if you consider losses, okay? Which would be 2.33 times the standard deviation distant from the mean, okay? Let's position on this graph value of equity equal to 0. Well, I just realized that I made a small mistake here, which I'm going to correct rapidly. Sorry for that. Excuse me for that, really. Because I took 50% here, and that should be okay. Please excuse me for that. So now it's correct, okay? And this, no, sorry, there is still a mistake to correct. Here it is. So the red line, the critical point, if you prefer, corresponds to a return on equity that would be minus 50%, that would bring the equity to a level of 50. Okay, so if you are in this situation, is that acceptable? The answer is yes. In this case, it would be acceptable. Why? Because you see that if our limit, which corresponds to 1%, is on the right side, it means that the probability of a loss higher than minus 50% would obviously be less than 1%. Okay, so this situation is acceptable. So to decide whether a situation is acceptable or not, we are just comparing the value of the return on equity for a limit of 1%, and we compare it with minus 50% to decide whether the probability would be above or lower than 1% for minus 50%. Okay, so if you have understood this, and normally you should be familiar with this type of approach, well, then we can make a simulation. Okay, so I remind you the rule here. And again, I just realized that there is the same type of mistake here. Sorry for that. Okay. Here we are. Well, so now I've made a few assumptions. I remind you the formula which we are using above on this table. Let's take some assumptions which I insist are realistic. Let's take a risk-free rate of 3.5%. Well, it depends where you are in the world, okay? And 3.5% is not the case in Europe, where we have for short-term rate, even negative values yet, okay? This is a kind of historical rate that would make sense, 3.5%. I don't know exactly what is the risk-free rate in Vietnam right now, but 3.5% would obviously be too high if you consider the situation today in the Western world, okay? But interest rates are moving up anyway. So let's assume here 3.5% for the risk-free rate. The expected return on shares, in other words, the expected return on the market portfolio would be 8%. Historically, that makes sense. The market volatility, the standard deviation of the return on the market portfolio would be 15%. That's also a reasonable guess. The cost of underwriting resources, let's assume 1.5%. Okay. The underwriting risk, in other words, the standard deviation of U is 6%. Here also we have some data which would show that these guesses are reasonable. The correlation between R and U, I'm not taking the covariance here, I'm taking the correlation, but you know it's these two things are linked, minus 0.1, okay? I've just used the correlation Y here, because you see in this formula, I have replaced the covariance between R and U by the formula standard deviation of R times the standard deviation of U times the correlation coefficient between R and U. This is equivalent to the covariance, okay? But for the simulation here, it's better to take it this way. The value of equity would be 60. The underwriting provision would be 60, so that the gearing L over E is 3, okay? So in our simulation, how are we going to calculate the investment return? Because the portfolio will be made of either the market portfolio. Indeed, we could have had a much more complex model with different lines of investment, okay? Shares, bonds, real estate, and so on. But this would have been much too complex for the purpose of this course. So let's assume, again, for the sake of simplicity again, that the insurer will invest either on the market portfolio or in risk-free bonds. In this case, the return on investment would be the proportion invested in the market portfolio, which is WM, plus the proportion invested in the risk-free rate, which is 1 minus WM times RF. Okay? And the investment risk would be the standard deviation of R, which would obviously be WM sigma RM, okay? Because the risk-free rate has a standard deviation, which is 0 per definition, because if it's a risk-free rate, there is no risk. So standard deviation would be 0, okay? So based on these numbers, what can we do? We can build a block table of simulation like this. In the first column, what do we have? We have the proportion invested in the market portfolio. We start with 5%, then move to 10, 15, and so on, up to 100%. In other words, the lower you are in the table, the higher the proportion invested in the market portfolio, with a shift of 5% for each line, okay? I could indeed have been more precise with 1% per line, but that's enough. So what is the expected return on equity? The expected return on equity, we can calculate it using the formula, the equity return, and considering the return on investment as well as the cost of fund, and you can calculate using the formula which is above in the table upper left, okay? CAR equal R times 1 plus L over E minus U times L over E. Based on this formula, you can calculate the expected return on equity, okay? And you have the list here. You see, the lower you are in the table, the higher it is, because the more you invest in the market portfolio, the higher the return you can expect, okay? But if you look now at the standard deviation, sigma R, okay? sigma R, which is WM times sigma of the market portfolio return, then you see that sigma R is increasing, moving from 0.8 to 15%. The last value for this is 15% because it corresponds to 100% invested in the market portfolio. So you have the volatility of the market portfolio. Now, based on sigma R, okay, you can calculate sigma K. Okay, sigma K, because you can calculate the variance with the formula you have in our table above. Okay, once you have the variance, you take the square root and you obtain this. You see, even with only 5% of shares, you see that sigma K is already 18.5. Why? Because you have a high leverage. Okay, is that acceptable? Then you will calculate. In this column, in the fifth column, the distance between the expected return on equity mu K and the 1% probability line. You take minus 233 sigma K and you find minus 32.8%. Okay, so based on the rule which we have here, okay, minus 32.8%. In other words, you have a probability of 1% to have a loss higher than 32.8%. In other words, the probability to have a loss higher than 50% is necessarily below 1%. So on this first line, the situation would be acceptable. Okay. In the last column, what do you have? You express this in terms of equity. Okay. The equity loss would be 6.6. In other words, 32.8% of 20, which means 6.6. You have lost 6.6, which is less than 50% of your equity. Okay. So you see, and then we move down. So you see, if you take, for instance, 50%, let's assume that we would like to invest 50% in share in the market portfolio. Okay. Based on this, you would have an expected return on equity that would be 18.5, but a standard deviation that would be 36.5%. And you see that the expected loss that corresponds to 1% probability would be 13.3, which is higher than half of the equity. So the probability of a loss higher than 13.3 is 1%. Okay, if you are at 50% of shares with equity of 20, obviously the probability of an ROE lower than 50% is bigger than 1%. So this is not acceptable. Okay, so if you look at it, where is the limit? You just see the limit would be there. Okay, if you take 30% of shares in your portfolio, okay, then you see that the probability of a loss of 9.5 is corresponds to the 1% limit. In other words, the probability to lose 9.5 or more is 1%. So the probability to lose 10 or more is less than 1%, but it's an extreme limit. Because if you move to 35, you see that we have 10.4, and therefore, you know, the probability to lose 10 or more, that is 50% of the equity, is obviously higher than 1%. So you see, with this simulation, we end up with a result which is similar, roughly similar, to what we have seen with the CAPM approach. It explained that our insurer, under these conditions, based on these assumptions, which I repeat, are realistic, okay, you just realize that insurers should not invest more than 30% in the market portfolio and hold 70% of risk-free bonds. Okay, so, and you see the conclusion. Insurers need to have a safe investment policy because they cannot accumulate risk on both sides of the balance sheet. Okay. Well, so this is the case of even though I didn't mention that, this analysis corresponds more to the non-life insurance business. Okay, when it comes to life insurance business, it's a bit different. Okay, because it depends on how the policy is structured. So we need to have now a specific analysis for the case of saving type life insurance. Because what is the cost of fund for the life insurance business? The cost of funds is the return for the policyholder. You know, it is a cost for the insurer, but it is a remuneration for the policyholder. And this remuneration, normally in life insurance, is stipulated in the policy. So there is no volatility there to a certain extent. Okay, the risk is not is less, because depending on how the policy is structured, indeed, but at least you know exactly how much you will pay. There is no uncertainty about the cost of funds, okay? Because the return for the policyholders, what it should be, is always stipulated in the policy, okay? So it's different from the situation in non-life, where you really don't know how much the cost will be, because it depends on the cost of claims and when the claims occur also. Okay, so let's consider this. That's, again, in life insurance, that's typically an area where the ALM can be applied. Why? Because if you look at the structure of the balance sheet of a life insurance company, it's a bit, to a certain extent, there is a bit of a difference with non-life. Why? Because usually you would isolate the asset which are financed with the insurance funds, and isolate also the assets which corresponds to the investment of the equity funds. So here, when I look at the asset side, okay, you know, I make a distinction between assets that belong to the equity and assets that are funded by the insurance policies, okay? And usually there is a link which is created between these two blocks, because within the policy, the remuneration conditions of the policyholders will be stipulated. So the income for equity holders, now let's look at the formula of the return on equity, would be the return on the assets invested with, which corresponds to the equity funds, okay? I write it RAE, that is the return on the assets financed with the equity, okay? Plus the return on the asset finance with the insurance funds, RAL, time L, okay? Minus UL, U, which is the return given to the policyholders, okay? In other words, the two first elements corresponds to the return you get on the assets which are either financed with equity or liabilities. But we make the distinction because we can assume that you can have a different approach to structure the portfolio financed with equity and the portfolio financed with the policy funds, okay? So the return on equity, if you want to express it a bit differently, you can isolate what the equity holders will get from the return on their own funds, okay? And then when you can get from the insurance funds, which will be the difference between what you get as a return from the assets invested with the insurance funds, minus what is redistributed to the policyholders, which is the cost of funds U, okay? Where you have here, you benefit from a kind of financial leverage. So now the situation will totally depend from the type of policy which has been issued. If you remember well, there are two types of, let's say, agreements concerning how the funds will be managed. Either you have what we call investments in the general assets, and in this case, the insurer would guarantee a certain return. Okay. Or you have funds invested in unit linked. Okay. In other words, the policyholders are bringing money. Remember what we said about the different policies in life insurance. In the case of unit linked policies, policyholders are bringing a certain amount of money to the insurer, and they ask for this money to be invested in a particular unit. Okay. And in this case, the return they obtain on the money they bring to the insurer will correspond to the return you can get from the unit where the money is invested. Okay? So what does it mean? If you take the case of euro policies, that is when the money is invested in the general asset with a guaranteed rate. Okay? So I call it UG to mean that the return is guaranteed. If the return is guaranteed, it means that the sigma U would be 0, because you know exactly how much you're going to pay the policyholders. You guarantee the rate, let's say 3%. So there is no volatility there. Okay, so the variance of the return on equity would be this one. Okay, and as you can see here, because of the leverage, you know, you need to control the risk because of a high leverage, and safe bonds are preferred. You know, if you guarantee, intuitively you will understand. This formula may look a bit complex, but basically it's easy to understand what's behind. If you guarantee 3% rate, you know, you have to be careful with the money you invest. Because if you guarantee a rate, you know, even if you have losses, you have to pay the rate. Okay? So you have a kind of rigidity there. Okay? And this is all the more risky if you have a ratio of L over E, which is high. Okay, so there is a need to control the risk because of a high leverage. Safe bonds are preferred. So in other words, typically what insurers would do when they have this type of policy, if they guarantee 3%, why do they choose 3%? Because they know that on the market, the safe asset where they can invest the money is just with a return just above 3%. We had an exercise on this. We assumed, for instance, that the insurance company was guaranteeing 3% and investing in a safe zero coupon bond providing 3.2%. So, you know, you just guarantee your return, okay, because you cannot take too much risk because you have guaranteed a payment to the policyholder. Okay, so this is a situation where you would invest your money mostly in safe assets. Now, if you have a unit link, then what is stipulated in the policy? The policy stipulates that your money will provide you with a return equivalent to the return of the unit where it is invested. In other words, in this case, the cost of funds will exactly correspond to the return on the asset in which the money is invested. You have U equal RAL. In that case, K is just equal to the return you get on your equity. Okay, and sigma K just corresponds to the standard deviation of the investments you have made, the return on investments you have made with your equity funds. Okay, and you know the risk is much lower. Okay, and you can invest the money in risky assets if the policyholder is ready to take risk. If the policyholder says, well, I want to have a high return, so please invest my money in a portfolio of international shares, because I know that you can expect more. Okay, you do so. Even if the unit is not doing well, even if the international shares have a price that has decreased over the period, the loss is not for you, the loss is for the policyholder, because that was initially the choice of the policyholder to take the risk. Okay? So there is no risk in this case, and the investment will depend on the choice of the policyholder. The risk is with the policyholder rather than with the insurer. If you summarize this, in the first case, you know, with euro policies with a guaranteed rate, the risk is with the insurer. And considering the leverage, the insurer will invest in safe assets. On the other side, if you have unit-linked policies, okay, the risk is with the policyholder. So the money of the policyholder will be invested where he wants. If he wants to take risk, okay, let's take a risky portfolio. If he doesn't want to take risk, okay, invest in safe shares. The risk that equity holders will take depends only on where they invest the asset finance, where they invest the money, which corresponds to their equity. Okay. Well, so that was the situation, the specific situation of life insurance policies. So now, having said that, it was the theoretical part of my presentation. I know that it's a bit tough, okay? So I ask you to look at it a bit carefully. You know that you will have an assignment. I will tell you more about the assignment at the end of this course. Since I know that it's a bit tricky, you will have to work on that, okay? To make sure that you take time to reflect on this and to manipulate all these formulas, because I can imagine that behind your screen it must not be quite easy, okay? So you'll come back on this during the assignment. What comes next has to do with some numbers, just to show you that all the conclusions we have made here in terms of structure of portfolios is exactly what you observe when you look at data. But I'm rather than looking at data now, I'm looking at my watch, and I just realized that it is close to the coffee break time. So rather than moving right now to the data analysis, well, let's maybe have a coffee break now. So I guess you heard me. As usual, 15 minutes. Okay. Good. Okay, so see you in 15 minutes. Okay, so let's start again. Ready? So just a few numbers now to illustrate what we have done. Breakdown of insurance investment portfolio in 2016. It is taken from Insurance Europe. And you see, it includes all the insurance companies. Investment, you see the gray part here, which investment other than asset held for index links and unit link funds. In other words, you have the two parts, as you can see here. Asset held for index-linked and unit-linked funds, which corresponds to life insurance policies, as I mentioned, which we call unit-linked. Remember, the case where policyholders choose the type of investment in which they invest their money. Okay, so this is isolated, and the risk associated to this type of asset is borne by the policyholders. Okay. When you look at the rest, okay, if you exclude the unit-linked life insurance policies, then what do you find? The structure is there in the circle on the right side. You see that bonds represent 64.3%. Okay. In other words, if you look at this, you see that it's a very safe type of investment with a wide majority of bonds. Okay, here you have nearly 2/3 invested in bonds. If you look at equities purely, it's only 3.8. So it's very, very small. You should add to this indeed holding in related undertakings, including participation, 15.4%. This would probably include also some equities, but you see that equities would not exceed something like 15 to 20% in the overall structure there. Okay, so these numbers illustrate rather well the conclusions which we have established in our analysis previously. Okay. Another type of data. This is for the former slide was about European insurance companies. If you look at the US insurance industry, you have distinction between life and so on. So you can see, if you look at the last column, which is the total, the bonds represent 65% and common stock 12.5% only. Okay. Real estate, a small portion, you see. So it's highly diversified, but basically a lot invested in bonds. Okay, so which is again a kind of validation of the conclusions which we have established before. Okay. So, and that's, you don't see much difference if you move from one line of insurance to the other, by the way. Maybe for life, we can have a comment, the proportion of bonds is rather high also, mostly because in life you have this guaranteed rates policies, which lead insurance companies to avoid risk, because when you guarantee a rate, it's better to invest in a safe type of bond that will guarantee your revenue so that you can cover your cost of funds, which has been stipulated in the contract. Okay. So again, you can verify that our previous conclusions are right here. If you look at the proportion of equity in pension funds, the pension funds have another approach because, they have very long-term maturities. And as you can see, if you have a long-term view, you are not so much concerned with the short-term volatility, so that it allows more risk. Okay. You just need to make sure, and you can anticipate your need in cash. And you probably have seen that with my colleague in portfolio management. If you have long maturity, you can take more risk, and because you are not so much concerned with short-term volatility, as I said. Okay, and you just need to adjust sometime your portfolio when you know that you will have to take some cash out, okay? And there you have to shift a bit towards when you need cash. By anticipation, you have to shift a bit towards more safe assets and a bit less risky assets. But as long as you have a long maturity, you can allow a higher level of risk, which is what you observe here, because you see that the percentage of equity allocation here is much higher than it is for general insurance. Okay, and particularly in the US, you know, there are aggressive pension funds with around more than, over the period, very often more than 50% invested in equity. But remember also what I said about pension funds. You know, there are some difficulties, and some people would argue that typically the case for the United States, that it was certainly not quite prudent to invest so much money in equities. Okay. Well, so that's for pension funds with a much longer maturity. Now let's, an interesting case. These are old numbers, okay, because I didn't get more recent for this group of countries. You know, these countries are interesting, particularly if you consider the situation of these countries in 2000. Okay, this is long ago, 20 years ago. But you know, I'm interested in these countries because in 2000, these were kind of emerging countries. You know, Czech Republic, Hungary, Poland were three countries which just had quit, let's say, less than 20 years before the Russian bloc, the Soviet bloc. Okay, so they were really emerging, entering into a new type of domain, which were the kind of liberal type of economic system and so on. Okay, and it's interesting to look at their balance sheet structure in terms of investment, where they invest their assets, life and non-life. Okay, what you see is that there are some big differences, first of all, you know, from one country to another. If you take Czech Republic, for instance, they have a proportion of shares which is around 16%. If you take Poland, you have 37%, which is very high, you know. And bonds did represent 40% in Czech Republic, around 50% in Poland, only 28-40 in South Korea, Turkey nearly not 100%, but 93% and above. So you see, the conclusion is, when you look at these numbers, first of all, there are countries where the level of shares is a bit surprising, such as Poland, with 37% of shares in life insurance. Okay. If you look at bonds, big differences from one country to the other. Okay. So how can you explain this? Well, normally I ask you the question, but here I'll be obliged to ask the question to myself and give you the answer. Well, actually, you know, insurance activities are usually highly controlled at the national level, with usually a certain degree of protectionism. Okay. And in most countries, particularly these countries, this type of countries, emerging countries, companies have to invest locally. They usually don't have the right to invest abroad, for instance. In other words, what's the problem? The problem is that they raise a lot of funds, because in emerging countries, the insurance domain is a fast-growing domain, and they accumulate more and more funds. And the question for this is where to invest. The answer is easy. They have to buy what they find on the financial markets. Okay. In other words, the portfolio structure in these countries is not really the result of a choice of asset managers. It reflects more the structure of the asset supply on the local market. Insurers buy what they find on the financial market, on the local capital market. Okay, so why do you have, for instance, in Poland, for life insurance, 37% in shares? Just because at that moment in Poland, they were still in the privatization process of their companies. After having quit the Russian bloc, the Soviet bloc, well, you know, all companies which were nationalized company, okay, they were privatized. You would talk about equitization in Vietnam, okay? And therefore, there was a lot of shares to sell, and there was a need for investors in these shares to contribute to the privatization process. That explains the high level of shares in the portfolio of Polish insurers, for instance. Okay? There are other countries, and that's probably very much the case in Turkey, okay, where the funds collected by insurance companies, the state tends to have a kind of influence to make sure that the insurance company will contribute to finance the budget deficit. Okay? And it is true in many of these American countries. In other words, and that's the case typically in Turkey, as I said, they contribute to the to provide, let's say, a demand to meet the supply of public bonds to finance the budget deficit in their country. It's a kind of insurance companies in this case can be seen as a tool for the governments to finance their deficit, with a strong influence usually, sometimes through nationalization. Some insurance companies are public owned, and therefore the money they have would be, mostly used to finance the public budget. Okay, so in other words, to conclude, if you look at countries, and I would say that it probably corresponds rather well to the situation in Vietnam now. I mean, maybe not so much today, but would you look at it let's say 10 years ago in Vietnam? For sure, insurance companies, the money would basically have first contributed to finance public action. Okay, but in any case, in these countries, the portfolio structure, the asset portfolio structure, does not reflect the choice of the insurance investors, but more the structure of the supply of assets in the country. Okay, so that was a specific comment on the case of emerging countries. Well, this is, if you want to have more about it, then there is also a paper which is quite interesting about this here, which I mentioned down there. So in the case of Vietnam, well, this slide, this is a document which I took, which apparently was published in 2013. I don't know where we are exactly today. I didn't find any other documents, but maybe there are some if you can find it. There are some investment restrictions. It is true in most countries, just for the sake of solvency. I told you the regulators want to make sure that the funds collected by the insurance company will not be invested in too risky assets. Okay, that's why in most countries you have a kind of restrictions, saying that insurance should not invest in this, or with limits to the proportion of certain types of assets which would be seen as too risky. Well, when it comes to the quality of assets, you know the distinctions between investment grade and below investment grade. Okay, investment grade in terms of rating corresponds to a rating between AAA and BBB. Okay, as long as you are at least BBB rated, then you are investment grade, meaning that in the US, institutional investors such as life insurance companies or insurers can buy investment grade assets, but they are not allowed to buy assets which are not rated investment grade. Okay, so this is a kind of investment restriction. Okay, but in most countries you have this one way or another. Here you have what I found for Vietnam. Okay, I'm not going to read all that. This is for your information, with a distinction made between non-life and life insurance. Okay, and it makes sense because life insurance is, I would say, to a certain extent less risky than non-life. Okay, and also in life insurance, it depends on the type of policies. Okay, when you have unit linked and the risk is with the policyholders, and therefore you can buy a risky asset. This is a risk for the policyholders, not for the insurance company. Okay. So there are rules. If you look at this slide, I'm not going into detail, but it's interesting to look at the two blocks. There are rules for the equity surplus, which the equity, as always, is a safety net, okay, which protects those who have brought funds in the balance sheet, and which are measured through the liability on the liability side, okay. So the equity being a kind of safety net, well, there are usually some regulations saying that equity should be invested safely. On the for the insurance funds, what comes from the sale of policies, the underwriting provisions, if you prefer, okay, then again, you have to be careful with that money, because that money is going to be used to pay claims, okay, and therefore it has also to be invested safely, hence these restrictions. Well, so now I told you that there is one risk. We have been talking about the structure of the insurance portfolio, of the investment portfolio, sorry, with reference mostly to the volatility of the, let's say, the portfolio of asset and how it would be reflected in the volatility of the return on equity. Okay. Now there is a specific type of volatility which we need to focus on, which is the volatility due to the movements of interest rates. Okay, which corresponds to what we call the interest rate risk, with a central concept which is used to measure this risk, which is the duration. And I'm assuming that you have seen this concept of duration with my colleague. I remind you just the measure of the duration here, and I'm assuming that you are familiar with that. Okay, it is a kind of average delay of when you receive the cash flows. Okay, and you take as a weight the weight of each cash flow for each period. For each period, the weight which corresponds to the weight of this cash flow in the total value of the asset. Okay, well, so this is the formula for D. This is just an illustration quickly, because you know that already. If you have cash flows for a bond maturity is 3 years, a principal of 1,000 with a coupon of 8%, with a reference rate, which is the market rate for this same maturity, which would be 5%. Let's assume a flat yield curve to make it easy. Well, then you have the cash flows that would be like this, 80, 80, and then the principal plus the last coupon, 1080. Then if you look at the present value of each of these cash flow, you have this, so that the value of the bond would be 1,081.7. Okay, so what are the weight? The weight to calculate the duration would be the proportion of each cash flow value within the total value. The first discounted cash flow, 76.2, represents 7% of the value, and then for the year 2, 6.7%, and the final cash flow, which is the biggest, 86.3%. Okay, so based on this, you can calculate the duration, which gives you 279. Okay, which is a bit less than the maturity indeed, because you have intermediate cash flows. This you know. Okay, so what is the meaning of duration exactly? Okay, it can be seen as an average delay. Okay, because what you calculate here is, an average delay, the weight being the importance of each discounted cash flow in the total value. Okay, but it is also, as you know, an interest rate sensitivity. Why? Because if you look at the relative change of V, which is the value of the asset, dV over V, okay, you find this, okay, and you see that D, the duration, is there, determining to a certain extent the sensitivity of the value of the asset if there is a change, dr, in the interest rate. Okay, if you can change this a bit, expressing in terms of an elasticity ratio, you see that minus D is just the elasticity of the value of the bond or the asset, any type of asset you consider, elasticity of the bond with reference to the change in the interest rate. Okay, so you know the duration. The reason why we use it is just because it's a sensitivity parameter. Okay, the higher the duration, the more volatile the asset, the price of the asset. Okay, so normally you know this. A 1% increase in interest rate results in a reduction of 2.66 of the bond price. You know, if you use this this formula. Okay, this is indeed, you probably know that, an approximation. I'm not going to go more into the details, but you probably have heard of convexity. You know that if you have a very precise measure, you find a slightly different result. Okay, and sometimes it may be important. But it was just these two slides to remind you the meaning of a duration, the importance of it when it comes to the analysis of the interest rate risk. Well, so now, if you come now to the insurance business, well, there are duration, and duration can be measured for any type of assets. Okay, you probably wonder, you know, there are durations calculated for equities here. Okay, and you are probably surprised with that because you know usually how to calculate the duration of a bond. But for equities, it's a bit tricky because you never know exactly how much you will receive because the dividends in the future, you don't know how much it will be. There is no maturity because it's infinite for an equity. How do you calculate this? Just let's come back to this. You know, if you define the duration as an elasticity ratio, well, using market measures, the volatility of the shares, for instance, and how it correlates with the change in interest rate, then you can have an estimate of D. You can have an estimate of the elasticity ratio for shares, and if you have an estimate of the elasticity ratio, well, you know D. So that's the way the duration can be estimated for equities, for instance, okay, or for any type of assets. That's why here, if you refer to the balance sheet of an insurance company, you could, for each of these assets, even though the durations are not indicated here, you could measure the duration of each of these assets. But if you look at the liability side, okay, we also have the concept of duration which applies. Why? If you take, for instance, fire insurance 1, what does it mean? You know that basically in insurance, typically in non-life, okay, you receive premiums first and you save the money because you know that later you will have to pay claims. Okay, so it's exactly like the case of a bond. If you have a bond, you have a certain amount which you are going to receive later, okay, with some time coupon in between, and based on this series of future cash flow, well, you can calculate the value of the bond, but also the duration. Well, when it comes to claims payment, well, you know that you will have to pay year after year a certain amount. So you have a series of cash outflows, which corresponds to the claims payment, and you can, based on this, calculate the duration for the fire insurance business line, okay, exactly as you calculate the duration for a bond, considering the different coupon payment. Okay, so if you have 1, it means the duration on the fire insurance business line. On average, you pay, you know, your claims roughly 1 year after you have received the premium. Okay, it's a kind of average delay here, which you can consider. And pension and annuities, indeed, in life insurance, you can see that the duration is much longer. Why? Because these are saving type of insurance. So usually when you enter into a life insurance plan, you enter for several years. So your money is managed by the company for a while. So that's why the duration is much longer. Whereas in non-life insurance, the durations are shorter. I mentioned that already, but if you look at liability, typically third-party liability, okay, you have 5 years. What does it mean? It means that when you receive premiums for liability insurance, usually you pay claims much, much later. Why? Because it takes time before you know who are the victims, who is responsible, how much you should pay to victims. Lawyers take time before they make a decision, okay? You have to wait for the decision of the court and so on, and it takes time. That's why you have a long duration for third-party liability. So you see, on the asset side, for each type of asset, you can calculate the duration. And on the liability side, for each line of business, you can calculate the duration. Okay? And here you have some numbers, which are, I say, reliable numbers. So how are we going to, based on this, how are we going to analyze the risk exposure to a movement in interest rates for an insurance company? So the duration of a portfolio is a weighted average of the duration of each of its components. This normally you know, okay? DP, which is the duration for a portfolio, is the sum of the weighted average of the duration of each component of the portfolio. So when it comes to insurance, we have, what do we have? A portfolio of assets and a portfolio of liabilities. What we are interested in is the risk exposure of equity holders to the interest rate risk, okay? So we isolate the equity, and we would like to know the duration of the equity, because the duration of the equity is a measure of sensitivity of the value of the equity to the change in interest rate. So since the equity is, when you look at, if you take the equity as a, if you isolate it, then it's made of two portfolio, A, portfolio of asset, minus L, okay? And the proportion of each is 1 plus LE for the assets. And because you have a minus, okay, for the liabilities, because it's A minus L, the weight of the liabilities is minus L over E, okay? So 1 plus L over E is the positive weight for the assets, okay? That is the proportion of assets calculated with reference to the value of equity, okay? It means that the total portfolio of assets is bigger than the equity. You have a leverage, but you take minus L over E, which is the weight of the debt in the portfolio, the weight of the liabilities L. It's a negative weight. In the ALM approach, you take the liabilities as an element of the portfolio with a minus for the weight, okay? So if you want perfect immunization, if you want to avoid interest rate risk, what should you do? Considering the formula which we have here for DE, we should look for DE equals 0. If we have this, then we have no exposure to the interest rate risk, okay? What is the condition for that in terms of asset portfolio? How should we invest the money if we want to immunize, okay, the equity against the interest rate risk? We need to have DE equals 0. For this, we need to have DA equal what is written here, L over E over 1 plus L over E times DL. Okay, so let's make a bit of calculation. Let's assume that we have, let's take non-life insurance. Assume that we have 20 of equity and 80 of liabilities with a total asset of 100. What should be DA to have 0 value for DE? Using this formula, we find that with a duration for the liabilities of 1.5, which corresponds roughly to an average of what we have seen on the slide before. I gave you the duration for different lines of insurance. Let's take for non-life 1.5 as a reasonable average, okay? Then you would find that the assets should have a duration altogether of 1.2. Okay. In other words, practically, when you see this result, the structure of asset supply, and in order to benefit from the spread between LT and ST yields, insurers own portfolio with longer duration and hence are exposed to the risk of an increase in rates. Let me explain, because just reading it like this may not be quite easy. So let me explain. So you see, normally to avoid the exposure to the interest rate risk, the equity holders of an insurance company should have a duration for the assets of 1.2, which means holding very short-term assets. Okay, but is that possible? Well, not really, because if you look at what you find on the market, you have shares or bonds, and they have, most of them, essentially long duration. If you buy shares, the durations would be around 6 to 7 years if you make calculations. If you have bonds, you cannot have only very short-term bonds. Okay, most of the bonds, they would be at least 4, 5, 6 years. So it's very difficult to achieve. Okay. Also, the insurers, if they have short-term liabilities, okay, they like to invest in long-term assets because long-term assets would provide a higher return than short-term assets, because long-term rates are usually higher than short-term rates. Okay. So for this reason, the fact that they would look for a return from assets a bit higher with long-term assets, and also the fact that the supply is made essentially of long-term assets on the capital market, equity holders are necessarily exposed to an increase in interest rates. An increase in interest rates would contribute to a decrease of their value because it would strongly affect their assets portfolio, which is made essentially of assets with a duration which is usually much higher than the short duration that would be needed to avoid the risk. Okay, well, this is for non-life insurance. Again, when it comes to life insurance, it's a bit different. Okay, because in life insurance, what do you have? Let's come back to this. It's the same approach, but now DL is 8. Why? Because you remember, in life insurance, the duration of the liabilities is longer. So with a longer duration, if you make the same calculation, you see that it's more feasible, because then DA, the duration of the assets, to immunize the equity would be 6.4. So it's easier to achieve. Okay, that's the first remark. Because it's easier, it is possible to find a portfolio with a duration of 6.4 on the market with a good mix of shares and bonds. Okay. Furthermore, the development of unit-linked policies has contributed to lower the interest rate risk. Okay, why? Because with the unit-linked policies, again, the risk is transferred to the policyholders. The equity holders will not bear the risk of the fund invested under this group of policies because the risk is transferred to the policyholders. So they can have assets, much longer assets. Okay. Because of that. Okay. However, pension funds with a much longer duration of liabilities may have difficulties to find enough long-term assets and suffer losses when rates are low. Well, that's another problem for very long-term maturities. If you take the case of pension funds, DL would not be 8, but DL might be something like 20, 30. Okay. In this case, to get immunized, you should have assets with a duration of around 30 years. Okay. Well, that's difficult for pension funds to find a portfolio with an average duration of about 30 years. In this case, the pension funds, they have this problem that very often they would expose to a reduction of interest rates. When interest rates are going down, okay, well, it's a problem because the maturity of their assets, the duration of their assets is so long that it would negatively impact their value. Okay, that's why, pension funds are very much interested in investment, as I mentioned already yesterday, I think, like infrastructure financing, such as toll roads or airports and the like, which are projects that may last for 20, 30 years with a guarantee to receive cash flows, usually covered by a state guarantee, okay, receive cash flow at a remuneration which is fixed for a very long period of time, that contributes to stabilize the return on their assets and also to maintain a high duration in their investment portfolio. Okay. So I have finished for this interest rate risk issue, where insurance company, as you can see, have to deal with a duration gap, that is a gap between usually liabilities and what they can achieve on the asset side. Okay, so now the last point I want to cover as part of this course before we go to a final recap and conclusions. Now let's raise the issue of the insurance capital adequacy ratio. That is the basic theoretical frameworks that inspire regulators when they look at the solvency risk. Okay, capital adequacy ratio, you probably have seen that in banking also. It refers to a certain amount of equity which is needed to reduce the probability of a failure of the insurance company. Okay, so let me skip this slide because this is a bit too theoretical. When I'm in class, I can still explain it, but here I think it would be a bit tricky. So let's skip this slide. I should have deleted it, but it's here. You can read it if you like, but let me move to the next slide. Okay. First of all, let me remind you what Solvency II is all about. It's about the capital adequacy rules. Okay, as you have in banking, you have 3 pillars. Okay, what are we going to look at when it comes to this solvency issue? It's like the Basel framework for banks, and it's divided into 3 pillars. You know, this is not quite new to you normally because, as I said, it's very similar in banking. Sets out quantitative requirements, including the rules to value assets and liabilities. Okay, particularly, you know, it's tricky when you want to look at provisions. You know, the fear for regulators is to have an insurance company that would underestimate the provisions. Okay, because if you underestimate the provisions, you hide part of the risk. Okay, if provisions are underestimated, it means that you boost the value of your equity, because the higher the provisions for a certain amount of assets held, if you reduce your provisions, that you increase your equity. Okay, so you hide your debts, if you prefer. So regulators are very much concerned with that. That's why they have established rules on how to calculate provisions. Okay, and based on this, you will calculate capital requirement to identify eligible own funds to cover those requirements. That is, in other words, they will try to see what type of assets can be held by insurance company to limit the risk, which is something we have already mentioned when looking at the investment portfolio with the restrictions of certain assets. Pillar 2 is set out requirement for risk management, governance, and so on. So I'm not so much concerned with that here. I'm not going to enter into details in this topic. You know, risk management, that is, you have to provide a report on how they follow the risk and serious they are in data collection and so on, in all the risk management processes, how the entities govern, what about transparency and all that, and also Pillar 2 has to do also with the role of the authorities controlling the insurance market, and you need to have and that's sometimes a problem in certain countries, to make sure that they have the qualification at the government level or at the regulatory level to make sure that you have the right people that can be trusted to control the insurance activity. Okay, and Pillar 3 addresses transparency, reporting, and the quality of reporting, and what needs to be done in terms of information by the insurance companies. So what we are going to focus on is essentially the capital requirements, which are part of Pillar 1. Okay. The idea is to find the minimum amount of equity that the insurance company should have to make sure that claims will be paid, or to make sure that the probability of a failure would be very small, okay? And small enough for being comfortable with the quality of the insurer, okay? So how does it work? How can we formalize this? So I come back to this representation of the equity value, okay? If you look at each of these elements, okay, investment portfolio plus reinsurance receivables minus the, let's call it the insurance debt, the underwriting portfolio, plus this block of net operating assets. Based on this, on the risk which corresponds to each of these blocks. Investment portfolio, it depends where you have invested the money, okay? The reinsurance, well, there is also a risk. There is a credit risk, in the sense that you are not quite sure that the reinsurer will be able to pay you. You know, if you reinsure, it means that you count on reinsurers to pay part of the claims. Well, are you sure that the reinsurer is solvent and be strong enough in terms of equity structure? I mean, to provide you with a good guarantee. That's why there is an activity of reinsurance rating, okay? All reinsurance companies in the world are rated, okay? And usually insurers would work only with reinsurers with a good rating. Because would they work with reinsurers with a bad rating, this would deteriorate their balance sheet, okay? Because this reinsurance block would be risky, okay? Well, so underwriting portfolio, it depends on the structure of the underwriting portfolio. There are some lines which are riskier than others, okay? And net operating asset, as I said, is not the most important point. It's usually a very small part of the overall risk. So if you integrate all these risks together with a portfolio approach, considering also the correlations that we've seen, okay, then you can define a probability curve. It's exactly like in banking, you know. In banking, you have all the different risk segments. For each risk segment, you have a probability distribution of potential losses, and you can look at the this global risk exposure to define a level of equities that would limit the probability of default. Okay, here the idea is exactly that, to limit the probability of default. So if you take into account each of this block, you put all that together, taking into account the correlations, and you obtain the distribution of the equity value for a certain period of time. For instance, if you do that at the beginning of the year, you can assume that at the end of the year, your equity value would have a certain value depending on that probability curve, depending on the volatility of each of the blocks you have here. Okay, so you start with E0, which is the level of equity at the day when the analysis is made, and you are considering a maturity, let's say 1 year maturity. What about the year to come? So you are interested in the value of the equity 1 year later. 1 year later, you can estimate that your equity will be E0, what you start with, plus 1 plus the return, the expected return on equity. Okay, so the expected value of the equity would be the value of equity today plus 1 plus the return on equity for the period. Okay, well, and you have this probability distribution. So here, for instance, you have 0, and the black part of the distribution corresponds to the probability of an equity which is negative. In other words, all the equity is lost, which means that if you are in the dark area, that you have a level of equity which is negative, so that in the end, there is not enough assets to cover the cost of claims, which is exactly what regulators don't want to have. Okay? So let's assume that this probability is considered too high. What should you do? Well, you should increase the level of equity, what the regulators will ask for. So let's come back to this. Let's assume that this dark area is too important, that it would correspond to a probability of a negative equity, which regulators would consider being too high. The regulators will ask for a change, for an adjustment of the equity level to comply with the rules, to lead to a situation where the probability of default would be much smaller than this, would not exceed a kind of default probability fixed by the regulators. So for instance, they would have in this situation an increase in the equity, moving from E0 to the red, the other value corresponding to the red dotted line. This change will contribute to what? To shift to the right the probability distribution, okay, because it will be based on the starting point, which is further on the right. So increasing in equity increases the expected value of the equity 1 year later, indeed. But it also contributes, because it also contributes to reduce the ratio L over E. If you increase E, the ratio L over E will decrease. The leverage will decrease. And if the leverage, the financial leverage decreases, then it will also contribute to reduce the volatility of the return on equity. Okay? So an increase in equity, first of all, has an impact to the right of the curve. Okay? Because you increase the equity and therefore you have a shift to the right. But in addition to this, you reduce the ratio L over E, which is the financial leverage, and you reduce the volatility. These two elements will contribute to reduce the probability of a failure, as you can see on this graph. Okay, so this is the basic principle, just to put it in a theoretical way, and you might ask me, yes, but practically, how do you do that? Well, practically, there are numbers, okay, and insurers, like in banking, they can have their own system of data collection and risk analysis, risk exposure analysis, to end up with models of that type, which can be quantified. As we have seen, the insurers have a lot of data. They know about the structure of their and the risk of their underwriting portfolio. They can calculate the risk of their investment portfolio. They can calculate correlations and all that, and generate this type of curve, okay? And then show that their probability of failure, in other words, of an equity lower than 0, is less than the minimum which is required by regulators. Okay? This is an approach which we call RBC, which is risk-based capital approach. Risk-based capital means that the equity required for the insurer depends on the level of risk exposure. Okay? Another approach, which we could have considered here, rather than increasing the equity, would have been to increase the reinsurance proportion, particularly to reduce, for instance, certain line of the underwriting portfolio which are particularly risky. I have mentioned, if you remember that, the finite reinsurance type of agreement, which the objective of this type of reinsurance agreement was to clean the balance sheet, I said, was a way to reduce the risk of the underwriting portfolio dramatically by getting rid of certain very risky line of insurance business. Okay, in this case, you would change the pattern, you would change the volatility of the return on equity. Okay, and therefore you may not need, in this case, an increase in equity, because you would have reduced the volatility of the underwriting portfolio. Okay, well, so now just to illustrate what you were saying, and I told you that insurers have data. So if we look at each of these blocks, each block contribute to the global risk exposure in the end. So insurance. Now explain what is the different blocks of risk and the main components of solvency capital requirements. In other words, the capital requirements correspond to the total risk, but the total risk depends on the different blocks which constitute the balance sheet of the insurance company. So here you have the contribution. That's a calculation that has been made by the European insurers. Okay, it was in 2013, but take it as an illustration. Okay, the different blocks of the balance sheet, how much they contribute, or in terms of percentage, what is their weight in the total equity required. So if you look at the at the portfolio of assets, it contributes for 36% to the capital requirement. Non-life underwriting risk, 62%. You see, it's a major risk there. Health underwriting risk, 6%. Diversification benefits. In other words, what it's saying that since here 36, 62, and 6 are calculated considering that each block is isolated, but there are correlation, as we know. So because of correlations, okay, we would contribute, and because of diversification, it will contribute to reduce this capital need. So the diversification benefits would be -9, okay? So that gives you the basic solvency capital required, which is 95. To this, you have to add 5 due to what regulators call the operational risk, okay? And you have a final solvency capital required, which is 100. But you see, if you look at the left part of this graph, you can see that the underwriting for non-life risk, you see, the biggest part of the risk is with the underwriting business, okay? Underwriting altogether represent to 62 and 6, that is 68, okay? That is more than 2/3 of the global risk exposure. This is for the life insurance business. For the life insurance business, most of the risk is in the investment side, because life underwriting is much less risky. Okay, because for saving type policies, you know exactly how much you will have to pay. Okay, just you may have an uncertainty when it comes to healthcare and death. Okay, for what we call personal protection. And here, diversification is even more important, and it's called diversification benefits, which is 20. So the basic solvency capital required is there, and here I don't want to comment on the 20 loss absorbed by technical provisions. This is a kind of accounting trick because of the way there are some provisions which are there for tax reasons. So I don't want to comment on this because that's a tricky kind of taxation issue. So ignore it in our analysis. What we are more concerned is what constitutes the major components here, which are investment risk and underwriting risk. Okay, that's for life insurance. With, as you can see again, life insurance, when it comes to the risk exposure, it's significantly different from non-life insurance. Okay, so what are the solvency requirements in Vietnam? Maybe I should upgrade this again, but this was the last data I got, which are the minimum levels of legal capital applicable to various insurance activities, depending on which line of business you are in. Here these are the conditions, the legal capital which is required, minimum. Okay, so I'm not going to comment this. It's just there for your information. Okay, so here you have an exercise on solvency. I'm not going to. You can look at it here, because it may be that you have something like this to discuss for your assessment. Okay, it's something that when I had time I would have done in class, but here you can look at it and. I may ask you to do something very similar for the assignment. Okay. So now it's we have still 20 minutes. Most of the course is finished. Okay. I just gonna do two things. First of all, I will conclude to comment on some trends which are developing fast right now in the insurance business, to kind of having a vision of the future of the insurance business, including in your country. And the second part will be maybe about the type of assignment which I will ask you for the grading of this course. Okay, so let me move to a last slide which you may not have. I will give it to you later. Excuse me. So now let's think of the future. I write it here. I wrote competition in insurance, structuring the organization. You know, insurance is a fast developing activity where many new players will be coming. Okay, and these new players, they try to see how they could compete against, I would say, existing insurers, which they would consider sometimes are kind of old style insurers. You know, so it's important now to look at this before we conclude on some very important points for the future. Okay, so let's reflect a bit on this strategic aspect. You know, that is important today because we are at the eve of, let's say, a dramatic change or dramatic changes in the insurance business, where those who are going to win are those who are going to structure their organization in the best way. Okay, so if you summarize, the insurance company is at the center of this representation. And as we've seen through the analysis of the balance sheet of an insurer, you have two activities which are rather different from a technical point of view. The underwriting activity, the activity of taking risk and providing a financial safety to policyholders. By doing so, you collect money, and therefore you also have an asset management activity. The underwriting activity is looking at the insurance market. That's where the clients are, those who are willing to buy insurance. The asset management, they are looking at the capital market because that's where they find the assets they are going to invest in to get a return. Okay, so the profitability comes from these two aspects. If you are efficient on the insurance market, then you will reduce the cost of insurance funds. Okay, if you are efficient on the capital market, you will increase the return on your asset portfolio, and by doing so, you can even be more competitive on the underwriting market. If you have a good asset management generating good returns for a rather safe portfolio altogether, then it means that you can take more risk and lower your premiums, because you know that you can do so if your return on asset is high enough to compensate the underwriting losses. Okay, so these two activities are really complementary. Okay, so you need to add intermediaries in this system. Why? Let's add reinsurance first. In the new system, reinsurance is traditional. You know, you have this traditional reinsurance like this, where underwriting part of the risk can be transferred to reinsurance. And you remember what we said. Now there are kind of new instruments such as cat bonds that allow reinsurers to go on the capital market to transfer part of their risk. Okay, so you have now a connection between reinsurance and capital markets to a certain extent. You also have a connection between the insurance market and the capital market, because particularly when it comes to, if you consider the case of large multinationals, they can have their own captives in insurance, or they can even issue some new instruments such as cat bonds issued directly in the capital market to cover their risk. Okay, so in this case, they would skip the insurance system to go directly on the capital market. Okay, so that's now, as I said, you need to introduce some intermediaries in the system. between the underwriting activity and the insurance market, you have a distribution network. Distribution is a key element today, indeed, particularly in non-life and life insurance when you are in the domain of the retail insurance. That is where you are targeting individual, okay? And the distribution channels traditionally are made of agents and brokers. I'll remind you the difference. An agent is selling specifically the policies of one insurer, okay? Whereas the broker is considering the needs of each customer, trying to find on the insurance market, I mean, among the many providers of insurance, what is the best solution? What is the company on the market which can provide the best solution for his customer? So the brokers are serving the customers, whereas the agents are paid by the insurance company to sell its policies, okay? Well, when it comes to asset management, indeed, each large insurance company has its own group of asset managers in-house, but considering the many specializations needed and the rapid change in the nature of the instruments and the complexity of financial engineering, now insurance company tends more and more to go through specialized fund managers outside their company to get the best from the capital market. Okay, so fund managers are kind of intermediaries which also intervene now between the insurance companies and the capital market. And the role of asset managers now, they are more and more to manage a portfolio of fund managers rather than managing a portfolio of assets. Okay, they select the best fund managers to make sure they get the best return for the risk they take when they invest the money of the insurers, of the policyholders. Okay, so here you have all the players. What can we add to this? Well, when it comes to distribution, particularly, you need more and more to collaborate with your policyholders, okay? And you need also to find the best way to approach your customers, to create value for them. And insurance tends to have more and more, let's say, they tend to use consultants outside to try to tackle some market segment for whom they would have difficulties to go directly to them. They also like to develop prevention. Okay, for instance, on the healthcare market, insurers can even be involved in healthcare. In the US, for instance, most large insurance companies, they have their own chain of hospitals. Why? Because they take control of the healthcare service to control the cost of it and to guarantee a certain level of quality. So if you want to buy healthcare in good condition in the US, you may be obliged to accept that in case you have a problem, you will have to go to this and this hospital. Either the insurers would have a direct involvement in the hospital structure, or they can have agreements with certain types of hospital to provide the service. That would be true also for maintenance, repair. Okay, you have a lot of connections now between insurers and some companies in charge of repairing or maintenance of equipment and so on. Okay, in other words, the insurers are now not just more and more, not just providing financial safety to the policyholders, but they provide a much broader service. It's easy to understand. If your house is destroyed because of a fire, okay, the insurance company traditionally would say, well, we estimate that the cost of rebuilding your house is 200,000 euros, okay? Well, but then when you have a check of 200,000 euros, what do? You are left with a house which is destroyed. You need to find the people to rebuild it and so on. And therefore now insurers have well understood that they might gain in competitiveness on the market by providing the policyholder with a broader service. Let's say, okay, don't worry, your house is destroyed. We're not just going to give you a check. No, it's not what we are going to do. We are going to rebuild it because we know that it's a burden for you. So we take care. And they would find the people working for them, rebuilding the house and so on. So that would be, there is an extension of the service, providing a physical service in addition to the financial service. Okay. And that's why they need partnerships and the like. Okay. And last but not least, okay, now, if you really want to perform and to increase your competitiveness, you need to go through a huge improvement in your IT systems. We have already mentioned the issue of InsurTech. There are many InsurTech now being created. Most of the InsurTech, after a few years, they are taken over by insurance companies. That is a way for them to integrate these innovations through digitalization and the use of big data, artificial intelligence. That will be necessary to improve their, let's say, productivity when dealing with all the numbers and all the data and so on they have to manipulate. But it will also be very useful to price more precisely the risk by integrating all types through big data analysis, by integrating all type of elements to know exactly who is a good customer, who is a bad customer, who should pay this price, who should pay this price. Okay? And then with the right price and the best service to provide to the people, knowing exactly what this market segment needs exactly, then you are in a position to provide exactly what is needed and price exactly as it should be, an optimal price for each market segment. Okay, so digitalization is certainly a trend which will be essential for the future, which will determine the degree of competitiveness of each insurer. Okay, so I think that this summarizes well the challenges for the future in terms of organization of an insurance company. All the cooperations which are needed, there is a need for a cooperative approach based on in-company and external expertise. Either you integrate within the company the expertise needed. It seems that is the case with everything that has to do with digitalization. InsurTech are taken over by companies. They want to have it in because they feel it is strategic. It has to be controlled within the company. There are other areas such as healthcare, maintenance, prevention, where this can be delegated through a kind of agreement with external partners, okay, to improve the overall efficiency of the system and the quality and the scope of the service provided to the customers. Okay, so having said that, let me now focus clearly on the challenges for the future, apart from this organization to increase competitiveness. I just summarize, and at the same time, I provide you with relevant recent documents, which I strongly recommend for you if you want to go further. Okay, I mentioned already the digital challenge. Okay, here you have the web link. And these are quite interesting papers to see how important this digital challenge is for the insurers. Okay. You have the document by Swiss Re, which is very complete from 2020, a recent one. The paper also, which was published in 2020, InsurTech and the Disruption in the Insurance Industry, Journal of Insurance Issues. You have the reference, these are the main one. Another challenge, which I didn't mention so much, is the climate change and insurance. How are insurers coping with that? You have a good paper for Europe, which is Sustainability Hub Insurance Europe, okay? And climate change with the Swiss Re group. I mentioned Swiss Re very often. These are two interesting papers. And last but not least, to a certain extent, it still relates to digitalization, but with a different point of view, looking at clients concerned with that. It's a cyber risk. The cyber risk is a major risk for which there is a huge demand of insurance coverage, but for which insurers have a lot of difficulties in terms of pricing and even definition of the scope of the cyber risk policies. Okay, so this is also a very important topic, which I wanted to mention as because it's part of the new issues in insurance. Okay, so I still have 5 minutes before I conclude this course. So 5 minutes just to tell you what you will have to do for the assessment. As usual, it will be a group work, a group of, let's say, 3 to 4 people. I don't like to have more than 4, okay? You will have a case study. You will work as a group on a case study, okay? And you will receive in few days, I would say probably 3 or 4 days, a document explaining clearly what you have to do. Indeed, it will correspond to things we have discussed together with a few calculations, few simulations probably to make, and maybe also an investigation in a specific topic, which I feel is an important topic today. Okay, well, so I have finished, and you will receive, as I said, very soon, a very precise document indicating exactly what you have to do for the assignment, which is a group work made of maximum 4 people. Okay? Don't ask me the deadline because the deadline will be fixed by your administration. I have no strong demand, but I feel that once you have the text, I think it would be reasonable to do it in the months to come. So, do you have any question? Indeed, if you have a question, I would like you to have it. Maybe you can take your microphone and ask me directly. Is there a question? I have a question. We do not have final exam. Last year, there was a group work, and I think I'm going to do the same thing this year, except if there is any problem with that, but I don't think so because it's this is what I've done each year was. Any other question? No? Nothing else? Yes, my email address, yes. Here it is. This is my email address. And indeed, you can always, if you have any question, don't hesitate to send me a mail. Okay? And I will answer indeed as soon as I can. Yes, my answer is yes. If you have questions, you can contact me directly. Send me an email. Okay? So any other question? No other question? It seems that T. Fuanganle is writing. Many of you are writing, so I don't know if these are questions or not. For the topic, I told you in 3 or 4 days from now. To buy one unit-linked insurance on buy traditional insurance plus separated investment in the fund by yourself. How do you think? Yeah. To buy one unit-linked insurance and buy one traditional insurance plus separated investment in the fund by yourself. You can always reproduce. You know, in finance, in investment, it's always like this. When you have an instrument on the market, you can always reproduce this same instrument by a combination. So you can do that. Of course, the question you need to ask is, do you have an interest in doing so? Because it may cost you more in terms of fees if you do it yourself separately. Okay. You also have to consider the taxation regime. Okay. I told you that typically in a country like France, it's better to go through an insurance company because you benefit from tax exemptions, which wouldn't be possible if you do it yourself. So it has a lot to do with taxation, the taxation regime. Okay, so I cannot just, for the case of Vietnam, I cannot just answer to you. But theoretically, of course, you can do that. Concerning the, I don't remember if I answered the question. So when will we receive the topic for this group work? I said in 3 or 4 days. Okay, give me a bit of time to write down the document. Insurance companies, they limit the maximum amount for you can invest in the unit-linked insurance. Okay, so when you say they limit the maximum amount for you, you can invest in the unit-linked insurance. But I got your point. Okay, I'm surprised because why do they limit? When you say they limit, how do they limit? Is it a proportion of your contribution only? Maybe it has to do with the fact that in Vietnam, because of the supply of assets, maybe it's difficult for them to create efficient unit-linked. Maybe they have control also on their investment, so that it becomes difficult for them to build unit-linked. You know, to have unit-linked in a country, you need to have a rather efficient financial market, capital market. Okay, so if there is a shortage of supply, you know, insurance companies, they have to comply with, not to comply, but to buy what they find on the market. That's why they may have some constraints when building unit-linked. Oh, 10 times the premium fee. So to be frank with you, I don't really see why they do so. Maybe because they don't want you to take too much risk. Because it seems that if they have a limit, it means that they would have the risk if you go beyond this limit. And to be frank with you, just like this, I don't really know why they do so. Okay. So is there any question? No, it's fine. So I'll tell you good luck to all of you. I'm pretty sure that I'm going to get good papers as usual from you. But when just make sure that anyway, rather than talking, I will provide you with a clear document concerning the assessment. Okay, and when you have this document, if there are some questions, don't hesitate to come to me. Okay, you have my email address, so it's easy. Okay, good luck. Take care. Thank you for saying it's a wonderful course. But you know, I'm fully aware that some elements might be very difficult for you to follow, and also very difficult for me sometimes to explain just with a PowerPoint session through an online session. I prefer to be in class because sometimes, you know, I can take go on the blackboard and give you more explanations with examples and so on, which is not possible here. So I'm quite aware that it must be very difficult for you to follow the course. As well as, I guess you will understand that it's not easy for us to have a good pedagogical approach to using just this online approach. And all the best for you. And I hope you are not too much concerned with the COVID, because I heard that it's getting worse in Asia. So I hope you will be safe. You will stay safe. Okay, then bye bye. Good luck, and do a good job for the assignment. And I'm pretty sure I'm going to get good papers, as I told you. See you. Thank you to all of you.